like I have to read a couple more times, but I'll
Yes,
go
I
ahead.
know. Yes.
Yeah.
Okay. All right. Good.
A lot of
So
things. Yeah.
yeah, I know there's a lot of things. There's more remembering, but if you understand the concepts, it makes it easier. Yes. Okay. So now what we're gonna do is let's go to chapter number 13, which we skipped before. So chapter number 13. Let me stop sharing. That is just this other investments that you should be aware of. Um, which includes also mutual funds, etc. So, alternate managed products. Here we go. Let me share that. Okay, you see my screen, alternate managed products. So, one of those products you need to know about is called a hedge fund. Again, you're not going to be selling hedge funds, but you need to be aware if somebody brings in a statement, what is a hedge fund? So, hedge fund is it's a very flexible type of investment. The hedge fund manager, so just like there's mutual fund managers, there's hedge fund managers, they are portfolio managers. They don't have any rules. They can basically invest in any investment all over the world. So hedge funds are for those people who like to take a lot of risks, have a lot of money, and they're similar to mutual funds. They're a pool of investments where your money goes invested into different types of investments. And so it can be divided into funds targeted towards high value investors. Mainly, you usually need to have a lot of money to invest in it. Some of them half a million, $1 million. And so it is mainly for that purpose. So for the high value institutional part, it is usually structured through limited partnerships or trusts. So usually trust accounts are usually it is high value trusts. They issue an offering memorandum instead of the prospectus. So like we said in the mutual fund, it is given out by a prospectus. Here the booklet is called an offering memorandum, and you can only sell them to accredited investors. Um, the So that means only those investors which have a high net worth. So what is the definition of an accredited investor? They need to be somebody with over $1 million net financial assets, um, or they have to have net they have to have net income before taxes of over $200,000 annually on their own, or over $300,000 with their spouse annual income. So obviously they have to be high net worth people in each of the two most recent years, over 2 years. So they have to have good income, good net worth, over a million, and then they can invest in hedge funds. So that is, oh, sorry, just a minute. I have to take this phone call. Just give me a minute.
Heidi, how's your reading going?
Hi. So I already did this exam. I tried doing it a couple of times actually,
I've,
because
I,
I work at the bank, so like it's really hard because like there's like two answers that are so
oh,
close.
it's similar, right? That's it.
Yeah.
I almost wrote, but I didn't write. I canceled it. But my friend wrote, and she got like 57, and she's so angry with herself. So I'm just so scared. I work with CIBC, but I don't know. It's too many things to remember, right?
It is. It is. It's not easy, and like my I feel like I've been here a long time, like my English and stuff, but like I feel like I understand the question, but then the answer, there's literally two similar answers that,
Yeah.
yeah, I know. And like a lot of these, like when we go through, like a lot of them, a lot of stuff is on exam, to tell you the truth.
Mhm.
But it's just tricky questions pretty
Yeah.
much.
I'm looking to write it in June.
Me too. I actually booked it already. I'm doing it on Thursday.
This Thursday?
Yes, I'm doing it because I already did it a couple of times. Like I need to pass because of my job, you know?
What bank are you in?
So I'm trying. I know it costs, but I'm trying.
I
Sometimes
booked
it's not.
mine. Ooh, man, Thursday, man. I don't envy you, but yeah, I know. Do you know what? I just realized that you could know. I know that you know the number of questions that are coming out from each chapter, right?
Yes.
So I don't know. I think sometimes there are lots of things you don't even need to know.
Exactly. No, there's like seriously, there's like a couple of questions that I did the exam 2 times and like the same question comes back. That's weird because like I'm like I know the answer, but like you know how I asked the question about the
Symptomatic.
price. Yeah, like even the price of the day, like it's
Yeah,
tricky.
yeah.
It will ask you what the price is that you bought the stock that day, like mutual fund, I mean.
It's
And like
confusing.
it's confusing because it gives you like by 2:30, by end of the day, by next,
Mm-mm.
so like you're confused. Yeah. Yeah.
And man, good luck. I wish you the best. Thursday
Thank
is
you.
is here already.
I stress about this so much. It's like, oh my gosh.
But
I
what,
can't study anymore. My head is like pounding, you know?
don't worry, you'll be fine. But what have you been getting? What scores have you been getting?
Like from 50 to 57 is the highest. Like I always in that range, you know? So definitely there
Wow.
is a problem why I'm not going over.
Yeah.
Hello. Hi.
Hi.
Yes, sorry about
Hi.
that. Yeah, that's good. You guys are chatting. Yeah, no problem. Yeah, so your study is going good. Yeah, that's good.
I did want to.
Okay. So the offering memorandum is basically it's the document has not a lot of information because it's for a hedge fund, and the prospectus has a lot of more detail about what is the objective, what is the investment about. Basically, hedge funds are just open-ended. They have a lot of different options. They can invest anywhere they want to, and there's no guarantees. So yeah, it's just you don't need to know, like in the prospectus you need to know what are the parts in the prospectus, part A and part B. But in the offering memorandum you don't need to know the detail, but it just has less information in the prospectus.
Okay, thanks.
Yes. Yeah, and then so here they have to be accredited investor, as I was mentioning. So this is in the book they mention about hedge fund strategies. There's three different strategies they can do. There's This is for the portfolio managers of the hedge funds. They can do event-driven strategies, relative value, and directional. What is event-driven? So what do the hedge fund managers do? They keep looking out, is one company buying another company? That's a merger or acquisition, right? So if one company, large company is buying a smaller company, then their stock price may change, right? Usually the one that is buying, their stock price usually goes down. And the company that's being bought, their stock price is going to go up. So they're looking for those, like every day is news, oh, this company is buying this company. So they will buy their shares, and also stock buybacks. So this is one thing, or there may be good news about a company, there may be bad news about a company. So that's event driven strategies. That's one thing they're looking for. Second is relative value strategies. They look for inefficiencies or differences in pricing of the bonds or stocks or derivatives. These are also known as, for example, they do arbitrage. Arbitrage is there is Toronto Stock Exchange. There's also there's also Stock Exchange. There's also the other, for example, Toronto Stock Exchange and New York Stock Exchange. We have some stocks which are listed on both, so they will buy from one market, sell in the other market, or they will look at where is it going to be, for example, um, where is it going to be listed at a lower price, the same document, right? So these things are all, for example, um, they look for those relative values which are maybe going to be mismatched. And so that's what their also objective is. Then in the directional is also strategies. So there's a stake on predictive movements in the market, price of equities, debt securities, foreign currencies, and commodities. So these are directional strategies. So they look at overall, is the price of the commodity going up or coming down, right? So and then they also invest in debt, they invest in foreign currencies, they invest in commodities, right? So they will invest in all these, right? So that is directional strategy. They look for if some stock is going really high and really low, that is also they look at those. So three types of strategies to look for, right? So these are their strategies. So hedge fund, here cost of hedge fund, there's incentive fees. So incentive fee is saying that the portfolio manager, they're going to get a special benefit by investing, by properly investing the money. Okay, so sorry, let me get that out of the way. So the portfolio manager, they are going to get extra bonus if the hedge fund goes up a lot. And so they get what is called a bonus, and it's not done on gross return. Example here, if the fund increases from $20 to $22 per unit, suppose it went up. Now they're going to get a bonus on that $2 increase, right? But then suppose the fund comes down, it comes down to 21. Now they will not get a bonus if it goes back up to 22 again. They're not going to double dip. So basically, there's no double dipping on the bonus there, right? That's called the high water mark. Once they get a bonus on performance, they don't get a bonus on the second time. Yeah, so they don't get a bonus on the extra amount. Hurdle rate is saying there's a minimum amount that they have to fulfill before they're going to get incentive. If they get, suppose, so if the hurdle rate is 10% and the fund gets 40% return, so in this case, um, the incentive fees will only be based on 30%. So there will be like a minimum amount. If they only make that minimum amount, they're not going to get a bonus on it. So these are two ways that the hedge fund is going to try their best to overall get it to increase, right? So it's in the best interest of that portfolio manager to increase the value of the hedge fund.
Sorry, I wanted to ask on the cost of the hedge fund. So, from my understanding, you're saying that if it was $20 and now it's 22, then the manager will be paid for the $2 that is above the $20. But if it goes to like 21, it won't be paid until it goes above 22 again.
Yes, that's right. If it goes up to 23, then he will be only paid on the $1 extra, right? If it goes up to 23, now it's above $22. From 22,
Yeah.
it went up only $1, right?
Okay.
Clear? Okay, good. Yes. So the advantages of the hedge fund is that there's a focus on absolute, not relative returns. So they can't say, "Oh, the market went down. That's why it lost money." No, it doesn't make sense. It has to be, it has to be um, absolute. That is, regardless of there's low correlation with the market. So whether the market goes up or down, it doesn't matter. You still have to make money in that, right? So that's what they mean there. And yes.
Sorry. So you always make the money in hedge funds, correct? Like there is no, you won't lose anything. Is that
No, there's no guarantee, but
okay?
they can't say that we didn't make money because the market went down, right? The returns are absolute. It doesn't, so it has a low correlation with the market. That's what we mean, right? So
Oh, okay.
clear, right? There's no guarantee, but they cannot say the market went down and so we lost money, right? Okay, and so the there's a there's a potential for lower volatility and high return. So there's a chance that you can get a lot of more profit there, but it's very risky also. So your question about is there guarantee? No, there's no guarantee. There's no guarantee. There's no there's market risk, there's liquidity constraints. If also if you put in money, you can't take it out, and you may be locked in for 1 year. You may be locked in for suppose 1 year. Okay, so that's also a negative thing. Like in the mutual fund, you can cash it any business day, right? And so there is always that issue there. Okay, any question on hedge funds? Is that clear?
Yeah.
Okay, let's go to the next one. So, principal protected notes. So, on the principal protected notes, what we're saying is that um, this is an example of an investment where here, so this one, you're guaranteed that your money is going to be, you can't lose your money in the principal protected notes. It is a debt instrument. It has a fixed maturity date, like usually 3 years. Okay, and so it is going to have a fixed maturity date and it pays interest, right? So underlying asset, it could be based on a stock, could be based on the mutual fund, could be based on the stock indexes, commodity, or hedge fund, right? So it could be any of those. And so the um, yeah, so that is, it could be anything basically. So what you're doing is you're investing in a type of investment, and if that investment goes up, you get a profit. If it goes down, your money is safe. You don't lose your principal. So that is the purpose of the principal note. So in that case, this is the objective of it.
Okay, so
And
this, oh,
yeah,
just a quick question. So this is kind of like GIC. You put money in, and then if it goes up, you get some money. If it doesn't, it just you don't lose anything, correct?
yeah, but in the GIC you're getting interest. Okay, here, have you heard of the
Oh,
stock index GIC?
yes, yes.
Yes, so the stock index GAC, that is similar to this one, right? In the stock index GAC, if the stock, underlying stock goes up, you get a profit. If it goes down, you can't lose your principal, right?
Yeah,
So that is similar to this one. Yeah, not a regular GAC, but a stock index GAC.
perfect. Thanks.
Okay, good. Um, so so that is what this is saying here, and that is why it's called principal protection. It's a great option for those who are risk averse, those who say, yeah, I want to put money into the stock index GIC, but I may lose money. I don't want to lose my money. So this is a good option for them, right? So that's what this is for. So in the principal protected notes, there's explicit costs, which are, so there's nothing's free. There's going to be commission there. There's management fees. If you take out money also before maturity, there is also a loss there you can get, right? So, um, and then there's structuring cost and guaranteed fees, and then there's common costs, which are other. There may be a participation cap. So let's take a look at the participation cap. So I'm actually going to show you again. I think let's do it that way. Um, yeah, let's take a look at that. Let me stop my sharing. Mm, okay, okay, you guys see my screen? This is the again Scotiabank website. I went to the GICs. Okay, so we're talking about the different types of GICs. Types of GICs. So there's cashable GIC. You can take your money out anytime. Non-redeemable, you're locked in. Okay, and then there's also the so going on, there's also market link GIC. So this one is what we're talking about here. Okay, similar. So this is similar to the principal protected notes. Okay, so why you want to put money into market link? There's no fees. Well, there should be some, but anyway, they say no fees. 100% principal guaranteed under CDIC. So if the bank goes bankrupt, up to $100,000 guaranteed by the bank, by CDIC. You can put in minimum $500, and your money is locked in for 2, 3, or 5 years. And the returns depend on the underlying index. So it depends on that. So there's market link GICs. Okay, let's take a look at this one here. So what we're talking about here, there's a cap rate and there's a minimum guaranteed return, right? Maximum, see here, maximum full term return. 3 years, the maximum you can get is 4.5%. So what does 4.5% over 3 years mean? If you divide 4.50 by 3 years, it means you can get maximum 1.5% per year, right? So that is what you have in your book as what they call a cap, cap rate, okay? And then there's a participation rate also. So this is the 4.5 per here. 5-year one, it's 10.5% is the maximum full return, right? And then whatever return you get, there's a 60-40 could be a participation rate. So 60% is yours, 40% is the company's. So the company, see, they're saying, so technically they're saying no fees, but actually whatever return you get, they get to share that return with you, right? They are limiting. If the market went up 10%, okay, the company gets to keep you their 6.5%. They're only going to give you 4.5, right? They're going to keep 5.5, sorry, and then we're going to give you 4.5%. So basically, they're going to be taking that return from you. So this is the market linked GICs. Is that clear?
Yes.
Right. So, and if it went down 0%, you're still going to get your full amount. If you look at the index values they give you for the past, you can see where's the past? Yeah, here we go. So you can see here past returns. So the full return, minimum and current change, yeah, showing you how much return was. You see here, January 12th, which matured, right? 11.43% it went up. Okay, they're going to give you 4.5% maximum. So the company gets to keep that extra amount, right? So tough luck. Here it went up 22%. The index, see, it was 968, it went up to 1189. They're only going to give you 5.5%, right? So as you can see, the market really did good in the last 1 year. 25% return, but they're only giving you 5.5, or before it was 7, before it was 10%, they were giving you maximum. So, well, this is the 59% increase, and you're only getting 13%. So how would you feel about that? Is that a good investment?
Well, you get the, higher percentage, but then they make way more than off you, I guess.
Yeah, yes, that's right. Yeah. Okay, so that I wanted to show you there. So this is what we're talking about here when we're saying that, sorry, share screen. Yeah, this one here, share. Okay. So this is what we're saying here, that there's some cost for it that you're paying out of your own pocket from that, for that guarantee. Okay, next type of product is commodity pools. These are managed future funds, are structured and sold as mutual funds. So they are going to be so they're similar to hedge funds, only they're not for accredited investors. So you don't have to be an accredited investor to get that commodity pool, and they are invested in different types of physical commodities and this and that, right? So so that is also there. Okay. Financial assets and currencies must be sold based on long form prospectus. So that is the okay, yes. So overall, the cost for commodity pools use a similar fee structure as hedge funds. Management fees, performance fees, high water mark paid regardless of performance. It's not unusual to find performance fees for 15-20% higher base management fee of about 2% of customer assets. So the commodity pools, they are basically similar to hedge funds. Okay, same. They have management fee, they have performance fee, high water mark. They have so there can be performance fees of 15-20%. Yeah, so it's very similar to that, but only thing is that you should look at who is the portfolio manager, their record, how good they have been in managing overall the investments. Have they taken out money from the equity, um, and other aspects like that. So those are also important, right? So commodity pools advantages are they share similar advantages with hedge funds, and they focus on absolute returns, and they have a diversification against traditional investments. And so a lot of top management, they come to manage the commodity pools. So there are still risks. Again, there's no guarantee. It's not like the principal protected ones there. Your principal is guaranteed, but here there's currency risk because they're invested all over the world. Leverage risk also is there. Trading risk is there. Liquidity risk is also there. So these risks are all there, right? So yes, so that is also there. Okay. Any question on commodity pools?
If you can go back the slide, I just wanted to ask, what does a drawn down mean? Declines in equity drawn downs.
So equity drawdown means overall, see if they have, for example, $100 million in the investments, and so if they sell a lot of the shares and they buy more bonds, so that's like an equity drawdown, right? So overall, what is the movement if they're taking money out from the shares and investing more in bonds? So that could be an indication that maybe they're trying to reduce the risk, right? So they do that. So they're going to shift a lot. They're going to sometimes do a lot of bonds. They're going to do a lot of shares. So that is what they mean by equity drawdown. Okay. All right. So next we talk about closed-ended funds. So closed-ended funds, they're similar to mutual funds, but they have fixed number of shares. So remember, the mutual funds are open-ended. Open-ended meaning that they are going to be continuously sold, right? Every day you can buy and sell a mutual fund. So those are the open-ended funds or mutual funds. They are open-ended. You can buy and sell them any business day. Your money is not locked in. In the closed-ended funds, they are going to be only invested at a certain time for investment, and then your money is locked in. So it's illiquid. We call it illiquid. You cannot take your money out. And the managed pool of securities are traded on a stock exchange market, and these funds can trade at par, discount, or premium over the net asset value. So they can be trading at equal or discount or premium, and they have a value because they're a discounted NAV. So meaning their value is a little bit lower than the NAV, and they're less because they're less liquid. So closed-ended funds, you're going to be locked in. So there's leverage risk because they can use borrowed money also. So basically, these are, of course, those companies which are going to be investing. Those investors who want to put money in for long term without any fluctuation, without any they're not too much concerned about taking the money out. They would put into closed-ended funds, and so the advantages are it can get more returns because people are not able to take their money out. We saw, remember the bias, right? The survivorship bias, that over time, those funds which are low performing, people will take their money out. Here, whether it goes up or down, you can't take your money out. So there's going to be a fixed amount there for investment, and so there's more chances of better returns in this one. Money market managers are not subject to unpredictable cash flow. They know how much money they have, and so they can also invest in long-term investment strategies, right? They don't have to keep a lot of money in cash. In the mutual fund ones, they need to keep 5 to 10% in cash because people need to take money out. They need to have money available to pay out the money, right? If the mutual fund is going down, a lot of people want to take their money out, right? They want to encash it. and they have to keep money in cash. But in the closed-ended funds, they don't need to keep it in cash, so that's a benefit there. Right? Any question? Clear? Okay. And then segregated funds. So segregated funds are the fund for a minimum period, usually 10 years. They're going to be for long term, right? And um, so yes, seg funds are issued by life insurance companies. So you need to be licensed with a life insurance um, license. You have to pass LLQP exam. Then you can sell segregated funds. So obviously only those people will do it, and only life insurance companies are going to do the segregated funds, right? And so there is annuitant, that is, so it is a life insurance product also, right? So the purpose of that is that if you have the segregated fund, you can yeah. So if you have a segregated fund, um, you are going to be having, so you will be the annuitant, you're based on the life. So whoever has a seg fund, if they die, so there's a guarantee on the amount of your investment. So there's guarantees in it, in the seg fund. Number one guarantee is that if the person dies, they will guarantee usually minimum 75%. It could be more. Okay. So so this is we're going to talk about these guarantees here. Yes, we're going to talk about them next, but it is based on the life of a person and there's guarantees on it. The contract holder, sorry, let me plug my battery. So the contract holder is going to be there. Yes. So the contract holder is going to be the person who bought it, and then there's a beneficiary who will get the money from the seg fund. So let's take a look at this here. So there's an insurance contract. You basically are buying it from the insurance company. Okay, so it is an investment product and it is an insurance policy also. So what are the advantages? We said there's two guarantees. Number one is there's a maturity guarantee. Maturity guarantee says if you hold it for 10 years, if you invested $100,000 and after 10 years it's worth 90,000, you will get 10,000 extra from the company. So you will get back your 100,000. So there's a 100% guarantee on maturity after 10 years. But if you take your money out before the 10 years, there's no guarantee. So that's one benefit of it, right? Another benefit is you can reset your guarantee. If the fund was 50,000 and now it's worth 61,000. So after 10 years, you can reset it so your principal is now protected. So it is now protected to 61,000. So you can reset your guarantee amount. If your guarantee was 50,000 and you want to reset the guarantee to 61,000, you can do that also. But then you must lock it in for another 10 years. So that's the negative thing about it. But that is possible that you can, you will lock it in for another 10 years then. So some people want that guarantee of the money, right? So and maturity, and also I should also mention about the annuity. We said based on the life. If the person dies, there's also a death benefit also. The death benefit is the same as the maturity benefit. If the person dies before any time, there's a 100% guarantee on the amount you put in. If it's higher, the family gets higher, or on maturity, if the value is 120, the family gets 120. But so that there's those benefits are there with the seg fund. That is, there's maturity guarantee and there's also the death benefit guarantee. Okay, clear? So those are the other benefits of the seg funds. So other benefit of seg fund is you can bypass probate fee. What is probate fee? Probate is when a person dies, they need to the government is going to review their assets, and that there's an option to bypass probate fees, and the creditor protection is there also. Yes, if a person has a business and they put money into seg funds, then they can also guarantee, they can also, if they have, they can also protect it from a loan. The bank cannot come after them. If they have a loan and uh, they don't pay their loan, and they have $100,000 in the seg fund, it can be protected from their creditors. They can, the bank cannot come after it. So that is a benefit. Okay. So the costs are, there's higher, so there's benefits here. So there's a lot of benefits. So there are going to be costs for that also, right? Um, the MER is higher for seg funds. So seg funds are higher, and the shorter the term of the maturity guarantees, the higher the risk and therefore the cost. The more of an equity component, the more the cost, because more fluctuation, higher the percentage guarantee, and higher the cost, right? So, um, so that also is going to be, so there's higher cost, but there's higher benefit also. So it depends, if a person is willing to pay the cost, they will go ahead and they will do that also. Creditor protection, we mentioned that. So, but you cannot put, you can't hide the money. You can't, if somebody's going to be doing, if somebody's going to be, for example, doing a, like bankruptcy, they can't put the money in the sec fund and say, oh, the bank can't touch it. They have to put in the money when they were financially okay, then it will be protected. Okay. The Yes, so protected funds provide various benefits. So like we mentioned, maturity benefit is there, and you can reset it also. And there's portfolio funds also. So you can also, um, so this is also a benefit that they cannot, will not, so that's a like negative thing also. Sometimes they may not give you a death benefit. If the client is over a certain age, right? If they're over 80 or 90, they may say you can't sell a sec fund. But in a mutual fund, of course, there's no issue about that, right? So this is the concept of the portfolio funds. So seg funds are beneficial for those people who want to put money away, lock it away, and guarantee a fixed amount, so that, and they can reset their money. So that's the benefit for the seg fund. It is more expensive though. Okay. So yes, next are ETFs. ETF or exchange traded funds. These are types of these are equities that represent ownership in a portfolio. So if you go on ETF, there's different ETFs in Canada. Most common, like famous ones, are like BlackRock ETFs. They are approved by different companies. They invest in market indexes. So for example, Toronto Stock Exchange, S&P. It is basically those who want passive investment, right? So they are the ones who want to be invested in passive investment, right? Um, so they're invested in a portfolio of securities and they track the market. They're similar to mutual funds, but they are on the exchange. So remember, if you want to invest in mutual funds, you don't have to go to stock exchange. On the TSX, you cannot buy mutual funds. You have to go to the bank or you have to go to investment company, right? And then you can get those, right? So it is similar to mutual fund and a stock, both. The ETFs are trading on the stock exchange. That is why it's called exchange traded funds, right? Um, so that is the concept. And so the advantages are, you basically buy the market, you have professional management, you have lower management fees, lower operational costs, and cash drag. So you do not have to keep liquid assets like mutual funds. So, um, so that is the benefit of the ETFs. So the risks are that it is, so the risks are that there is a, similar to stocks. So again, you can lose money, you can gain money. There's risk there, market risk is there, foreign currency risk is there because you're invested in foreign also, and you have got so yes, so passive management, commissions, unsuitable for use in systematic withdrawal plans. You cannot do like automatic withdrawal. There's cost also for ETFs for short-term trading. Usually they don't want you to buy and sell for like a short-term. Um, there's no drip plan. They do not trade at net asset value. So all these are different things for show you. There's tax efficiency for ETFs also. Um, so yeah. So basically, you can go to this exchange, you can buy it there. So there's a lot of ETFs which are on the commodities, like for example, gold, silver, uranium, oil and gas, etc. Right? Um, and so their performance is just going to be following along with your indexes, whatever you're invested in. And so there may be a tracking error. You cannot get 100% same as the stock exchange, right? So that's not going to be possible there. You do need to monitor it still, right? So that is also the thing there. And the cost. So MER are lower. So keep in mind, ETF MER is low. Then you have mutual fund MER. Then you have seg funds MER. So that is how the MERs are. The MER is lower because it's a passive investment. You are just investing in those investments here, which are just following a certain investment, right? So let's take a look. Yeah.
Sorry, the exchange traded funds instead of the mutual funds. So like these are not really monitored like mutual funds are, correct?
What do you mean monitored?
You know, like that's why the MER is lower. Like why is it lower than the mutual funds?
Yeah, they're not monitored as basically you can say they're not going to be buying and selling a lot of the investments within the fund. They have a recipe and they will just follow the recipe. They will not change, they will not buy and sell a lot of the stocks, right? So that's why, because they're not doing a lot of trading, their costs are lower, right? So their MERs are lower accordingly, right? Let me show you actually here on the website. Let me show you here. I just brought that up here, the investment fund. So you can see my screen. Let me hide this floating to yes. So this is, I went to BlackRock website. BlackRock is one of the largest ETFs in Canada. They're also known as iShares ETFs. So here, if you go to ETFs, so you can see the names are based on the index. So iShares S&P TSX 60 Index ETF. It basically is going to follow the market. And you can see the return 1 year, 31%, because the market went up. So if you had invested in this in May of last year, your investment would be up 31%. 3 years is 10%. So you can see that since inception, 7.46%. And then the composite index is, so this is showing you again another one. So this is core. This is invested in another index. So there are different ones, right? This is bond index. So this is invested in the formula is similar to bonds. Now bonds, as you know, are not doing that good. It's only 4% on this one. In 3 years, 1 year is actually minus because interest rates have gone down. So, you know, bond prices, they go up. And so then the yield is going to go down. And so overall, it's showing you there. So if you, and this is in US market. So the US market, S&P 500 is US. And so it went up 28%. So the MER is lower because they're just going to invest the money same as the US investments, right? So example here, overview, it is invested in portfolio 500 US large cap companies. It's low cost and it is for long term. As you can see, overall, it's been going up. If you put in 10,000 here, it would now be worth like $45,000. So what is it invested in? So it is in S&P 500 index. What is the portfolio? Should give the type. So see the fee, man, it's 0.1%. So as you saw in the other mutual funds, they are like 1%, 2%. The MER is very low on this one, right? The risk is medium. Here's the holdings, yes. So Apple, as you know, Apple company is doing really good. It's got investments in there. Microsoft, Amazon, everybody's getting things from Amazon, Facebook. Then Alphabet is also a large company. Berkshire Hathaway is that company by the famous investor. Morgan Chase is a large US bank. So as you can see, these are the main ones, the top 10. So it is invested mainly in these investments, and it will, so of course it is in all over in US IT companies, healthcare, financials and all. So that's what we're mentioning here in terms of the investment types, that it is investing in those types of investments. Okay. So in ETFs, they're similar to stocks and different than mutual funds. So they're listed on main exchanges, and the mutual fund purchases directly from the mutual fund company. And so the features shared by mutual funds are they represent underlying holding of baskets of securities and reflect performance of basket, incurs ongoing management fees, and they have substantial market coverage. So these are the fees, these are the features which are shared with mutual funds. So very similar to those, but they're different because they are on the exchange and you can trade them throughout the day. Okay, just like stocks, when you go on the internet, you can see the stock price going up and down, right? Same thing, ETFs, you can see the price going up and down and you can buy it. On the mutual fund, as you remember, mutual fund, you don't know the price until the next valuation date, right? So that is a difference there with the mutual funds. Okay. So their liquidity is not dependent on units. They're open-ended trusts. And so they are mainly, you're just following the yield of a market index. You just mainly, the objective is to follow it, not going to be better than it. It's just going to follow it. Okay. If you want growth, then you have to go to mutual funds. If you want to beat the market. So there also you'll buy it on the stock exchanges, and there are alternate managed products like closed-ended funds, ETFs, commodity pools. So these are also provided there. If the hedge fund has 4% hurdle rate and the manager has like a gain of 9%, so there again they're similar to the seg funds. The hedge funds. Here there will be a hurdle rate and there will also be incentive fee, high water mark also, right? So there are risks here also: liquidity risk, performance risk, credit risk, currency risk. And so trading in a commodity when its price is at limit, lockup limit. So there's a maximum price in which they can reach on the day. Okay, so so when its price is at lockup limit, commodity contract will deal limit price for maximum one day move up and down. Yeah. So what they're saying here is that the price may move up and down up to a certain limit on a day, and there's a limit on that also. So that is called the trading. You can say the trading contract issue. If it's on so some of the ETFs are based on a commodity. For example, oil. You can get an ETF based on oil price. You can get an ETF based on other stock prices also. So the purpose of the ETF is that you're just following the market, and so your investment may go up or down based on the market, right? If you want that, then the ETF is a good idea. So let's just take a look at the textbook. I think I covered everything in the ETFs. Let's take a look at that. This is the textbook. We are on chapter number 13. So, and the alternate managed ones, yes, chapter 13. This one, yes. So PPNs we talked about. There's different costs for those. Then there's we talked about those costs and the risks. So all these risks you should be aware of: performance risk, credit risk, currency risks. So what are hedge funds? We talked about those. There are alternative mutual funds. Yeah, I think we covered most of it. Anything we didn't cover in in that chapter. Did you guys, is that clear? I think we covered most of the things. Yeah, accredited, we talked about accredited one, offering memorandum. So your question about what is in the offering memorandum, it basically describes rights of the investors, 2-day right of this and that. And yeah, it's basically like a prospectus. Okay, so yeah, I guess that's the main thing in this chapter. I think we covered everything. So we've done two chapters. We did chapter 9 and chapter 13. We did some questions. Tomorrow we'll do some more questions, and we'll finish off. So we started on overview of Canadian financial marketplace, economic principles. Have you guys read through the KYC and the finance one? Those two, I don't really think there's much I can explain there. Those two chapters, are you guys okay with those two chapters? Do you want to do more questions, or what do you want to do tomorrow?
I was wondering about chapter 3 about I think there's a lot of that on exam about
Yes, economic principles. Yes, we're going to do those tomorrow. Yes, that's important. You're right. Yes, yes,
Yeah.
we're going to do. I'm going to cover chapter 2 and 3. Chapter 4 and 5, I think we can just. There's not a lot in that. I have a summary. We can go through those. Yeah, we will go through those tomorrow. I'm going to send you guys a link for a mock exam. I have mock exam of 100 questions. I'm going to email that to you guys now. You can start doing that also. And then if you have any questions, let me know, so you can practice the mock exam also. Okay?
Okay.
So I'll send you those. Anything else before we sign out?
I'm good.
Okay.